Nick, thought about what you mentioned, okay, about two of a kind. I think it's interesting that I share a little bit my thoughts, and you can share that with investors. And if it's interesting, looked at the web page. Obviously, two products, Halo, and the other one in the end a premium and a light version, D2C brand, very typical. Actually trying to move here. Obviously, and now I'm showing you, I didn't sign up, but basically showing you the latest communication was clearly in this array, but I can see that before it was a very typical D2C brand. Similar imaging is Xenium, similar imaging is most D2C brands. Actually love the idea of D2Cs. I love them. Basically, technology has reached a certain point that doesn't make sense, or the development of a product category doesn't make sense. AcuView can put a lot of, or any contact lens or eyewear company can put a lot of budget, but the product is not. It's going to get marginally better. Doesn't make sense to pay those insane markups for distribution, for branding. Sell it direct to consumer. I would say the big problem, and OEM it and then generate a bunch of on-the-go services or support services. I would say the challenge is the same. You have distribution, you have a brand, and you have offering. Distribution is in D2C, the trap is not so much that you have a very expensive in-build distribution. Is actually you depend on someone else's distribution, be it social media. And I'm not telling you anything that everybody doesn't know, but this becomes very big because most brands end up relying on this digital. So I think this is absolutely key. What I bring up here is distribution needs to be worked around. Social media can be the starter, but you need to evolve from social media. Obviously, I understand there's a subscription model and retention. However, if you are still going to depend on social media for your growth, because you're making less money than you should, you're not profitable, and you actually need to accelerate growth, you will depend on social media. So that ends up eating budgets. So you have higher retention, you'll have higher margin, your competitors will have higher margin if they have been following you, and you'll actually enter a bidding war. So you're trying to distribute your goods through a highway before the highway or the distribution channel is some partner that's taking a big chunk of your margin and is doing a very big markup. Now you have a highway where the owner is some social media empire, and they increase prices based on bidding. So it's quite complicated. So there's always needs to be an alternative strategy in terms of distribution, partnership, another way to go to market. I can think of several, but I think this is absolutely key to understand where the investors come from there. And that's going to be the two other branches, which are branding and offering. And branding, this is differentiating from this traditional D2C, which is basically an aesthetic play. Hey, I don't want to oversimplify it, but we're cool. Look at how, yeah, but they all look the same. You truly need to have some different story, take some risks. There's some brands that I can bring up in terms of brands that took a little bit of risk, but you need to have a long time horizon. Because marketing is a little bit like a wave. Branding is a wave. You need to actually invest one after the other, and eventually you'll get the large tsunami, if I can use that metaphor. And then the offering. I think this is absolutely essential. Okay, let me go to here. And this is just basically an analysis that we did on a company, because we're helping my friend in Hybro. He has a wellness, men wellness, and I think this is absolutely essential. If you're trying to sell one product, it can work initially to capture demand, to have a destination kind of product category. But then I think this is the beauty of the wellness, the men wellness product categories, and this is a thing that I think is essential, is how do you amplify to eye wellness, and you offer different products and services. You might be driving penetration into the market with a destination category or a loser, money loser one. Okay, for example, in the sex drive kind of for Hims, or traditionally had been that. I think that can be very interesting, but that's absolutely essential, because then you can justify to customers, hey, have I checked the app? Have I gone actually to check two of a kind? Oh, yes. Now there's this other offer that I'm very interested in. There's other product category. I'm not saying to sell Viagra on this, but selling other product categories is absolutely essential to generate some product categories that are more frequent, less frequent, that you have that mind share, and that you truly have repetition, and you can upsell. You can lose some money on some products, and you can make it with the others. I think this is, if that's the strategy, and we can have a discussion from here, I think it could be super interesting. Obviously, as I have my heart in D2C, and I think it would be amazing. But in general, except Hims and Hers, that actually has become profitable, supposedly adjusted EBITDA. But I think this is essential. We need to understand very well what's the picture and distribution. It can't be social media. That doesn't work. Only with social media, it just doesn't work. Doesn't matter what the performance marketers say. Branding, absolutely essential. That intangible is not, people don't like it. It's not numeric, but it's absolutely, this is why you have brands like Dove just every year selling similar products and just making millions and millions. And it's absolutely essential, the offering, amplify it and grow it, and not stick to 2 products or 1 product that does exactly the same, because that's not going to generate repetition. That's not going to generate a reason to come back. I hope this is helpful, and we're going to have a discussion from here. Thanks.